Okay, so it is Sunday, February 1st, 2026. And if you've been watching the financial world for the last, 48 hours, you probably have way more questions than answers right now.
Oh, absolutely. It's a state of total confusion.
Because the numbers on the screen are telling one story, but then if you actually try to do anything in the real world, you get a completely different picture.
It is the definition of cognitive dissonance.
Mm.
We're seeing this historic split between what the market price is and what the actual value is.
That's what we have to dig into. The big headline everyone's screaming about is the crash. On Friday, January 30th, silver, which has been on this incredible run, it just fell off a cliff.
A 30% drop in a single trading session.
Right, it went from an all-time high of, around $121 down into the 80s. In any normal market, that's a collapse.
On paper, yes, it looks like the bubble just burst.
But here's the paradox, and this is really the mission for our deep dive today. Try to go buy an ounce of physical silver right now.
Yeah, good luck with that.
I don't mean a paper contract, not an ETF share. I mean the actual metal. Go online, try a coin shop. You can't. The shelves are bare everywhere, from Costco to the U.S. Mint.
Which makes no sense.
So how does that work? How does a price crash while the product completely vanishes?
It doesn't work.
Yeah.
Not in a healthy, functioning market anyway. I mean, in Econ 101, if the price drops 30%, it's because there's a glut of supply, right?
Yeah.
Warehouses are overflowing.
Sellers are desperate to get rid of it.
Exactly. What we're seeing is the complete opposite. The price is plummeting on the futures exchange, but the actual physical vaults are being swept clean.
So we need to connect the dots. We have this bizarre situation in precious metals, but it's not happening in a vacuum. There's this other massive geopolitical event happening at the exact same time. We're getting reports that China has, essentially pulled the trigger on an $850 billion debt sell-off.
And that right there is the engine. That's what's driving this entire machine. If you want to understand why silver is vanishing, you have to look at the bond market. These aren't two separate stories.
They're the same story.
They're the exact same story. This isn't some glitch in the matrix. It's a geopolitical divorce. And frankly, it's just a brutal return to the laws of mathematics.
Okay, let's start with that phrase then. A geopolitical divorce. It sounds dramatic. We've been hearing about decoupling and trade wars for years. What makes this moment right now in early 2026 so different?
It's the scale and the speed. The catalyst was what everyone's calling the trade war of 2026. When the U.S. put those 60% tariffs on Chinese goods, I think the whole world just sort of held its breath.
Right. Everyone was waiting for the retaliation. Would it be a blockade of Taiwan, a cyber attack?
And instead, they went for the wallet.
They chose math.
They chose math. For 20 years, the whole global economy ran on this one specific deal. China sends us cheap stuff, we need to pay them in dollars.
And they use those dollars to buy our debt.
Exactly. It kept our interest rates low, it kept their currency cheap. It was a symbiotic relationship. But the tariffs just broke that contract.
So that recycling loop is officially broken.
It's completely shattered. And China isn't just stopping new purchases. They are actively selling off what they already have. And we should be really precise about that number you mentioned, the $850 billion.
Yeah, let's drill down on that. I've seen headlines with $760 billion, others closer to $1 trillion. What are they actually dumping?
So the $760 billion figure, that's roughly their holdings of standard U.S. treasuries, government IOUs. But the real nuclear option is when you add in agency debt.
Agency debt. So we're talking Fannie Mae and Freddie Mac.
We are. The massive entities that basically backstop the entire U.S. housing market. When you combine the treasuries and the agency debt, Beijing is holding about $850 billion worth of leverage.
And why does that matter so much?
Well, think about it. If you dump treasuries, you hurt the U.S. government's ability to fund itself. But if you dump agency debt, you are directly attacking the American homeowner.
Because that debt is directly tied to mortgages.
Precisely. It is a loaded weapon pointed straight at the U.S. housing market. And all the data shows they are selling this paper to buy gold. They've been on a gold buying spree for 28 months straight now.
So they're swapping paper promises from what they see as a hostile government for a hard asset, an asset with zero counterparty risk.
They saw what happened to Russia's dollar assets back in 22. They know that if things get really hot, those assets can be frozen with the flip of a switch. Gold in your own vault cannot be frozen.
Okay, but let's play devil's advocate for a second. We've heard China is selling before, and the market just kind of shrugged and absorbed it. Why is it causing such a panic now? Can't the Fed just, print money and buy the bonds to keep rates stable?
That is the trillion-dollar question. In the past, yes, the Fed could step in, but we've entered a new era, what economists are calling fiscal dominance, meaning the sheer size of our debt pile, which has just exploded in the last few years, is now so large that it matters more than the Fed's interest rate policy.
Right.
The Fed's trying to do quantitative tightening, right? They're trying to fight inflation.
Trying to shrink their balance sheet.
Yes. So if they suddenly pivot and print $1 trillion to absorb China's bonds, inflation just reignites instantly. They're completely trapped.
They're neutralized.
And this is where it hits your kitchen table. This isn't just some high finance game. The 30-year fixed mortgage directly tracks the 10-year Treasury yield. So when China dumps bonds, the price of those bonds has to fall.
And when bond prices fall?
Yields, the interest rate, have to go up to attract a new buyer. It's just supply and demand. If China dumps $50 billion in bonds on the market, rates have to spike.
So mortgage rates are basically divorcing the Federal Reserve. The Fed can want lower rates all day long, but the bond market is just saying no.
Exactly. Sources are now predicting that mortgage rates are, just mathematically, heading toward 9% because of this.
9%. I mean, that freezes the housing market solid.
It freezes everything. It destroys the wealth effect. If your house value drops because nobody can get a 9% mortgage, you stop spending. The entire economy just grinds to a halt, and China knows this. They're using our own debt against us.
Which brings us back to the silver mystery. If the dollar is under attack, bonds are toxic, the housing market is freezing. Logically, everyone should be sprinting for the lifeboats, for gold and silver.
And they are. That's the thing.
They are. But the price just crashed 30%. That's the part that's so confusing. If demand is through the roof, why did the chart just fall off a cliff on January 30th?
This is what we call the silver anomaly. And it is the clearest sign you could ask for that the market's plumbing is completely fundamentally broken.
Okay, so let's get into the specifics of that.
Okay, so on January 29th, silver hits $121.64. Then, in 24 hours, it gets smashed down into the 80s, a 30% discount.
Which should mean there's a fire sale. Nobody wants it.
Right, but look at the physical world. The Perth Mint in Australia, one of the biggest, most respected refineries on the planet, sent out a notice saying they are pausing all wholesale orders until February 23rd.
Pausing orders. How common is that?
It is incredibly rare. Their notice used the phrase increasing demand and said they were moving to allocations. In the wholesale business, allocation is just a polite word for rationing.
They're telling their distributors, stop asking, we don't have it.
We don't have enough metal to give you what you want. And it wasn't just Australia. The U.S. Mint's website. It actually went dark during the crash.
That was wild.
That was the moment my jaw hit the floor. When the site finally came back online, the spot price of silver was crashing down to $85. But the U.S. Mint's price for one American silver eagle coin, it went up. They listed them at $169.
Wait, hold on. Let me get that straight. The market price on my screen says 85, but the U.S. government itself is selling the physical coin for $169.
That is an 86% markup over the spot price. That spread right there is the difference between paper reality and physical reality. The paper price is a distraction. The physical reality is that the metal is gone.
And we saw similar reports everywhere. The Royal Mint in the UK, out of stock, dealers in India defaulting on their deliveries, even Costco putting limits on purchases. It feels like a bank run, but on metal.
It is a run on physical inventory. And if you really want to see the epicenter of the drain, you have to look at Shanghai. The Shanghai Futures Exchange vaults are emptying at a rate that is, frankly, it's alarming.
How fast are we talking?
We have data showing 94 tons were removed in just a few days. In one single session, 27 tons were physically loaded onto trucks and just driven away.
Wow.
At this burn rate, the Shanghai vaults could be completely empty in less than 3 weeks. It's like pulling the plug on a bathtub while the faucet is turned off.
There is one other technical term in the notes I want to unpack: lease rates. It says the lease rate for silver spiked to 39%. What does that even mean?
Okay, so in the industry, major players, bullion banks, refiners, they often lend and borrow physical silver from each other to manage inventory. It's just like lending money.
Okay.
And usually, the interest rate to borrow a bar of silver is tiny, fractions of a percent. It's almost free. But right now, that rate is spiked to 39%.
Which means Well,
It's a
true.
massive panic signal. It means the entities that actually own the physical bars are refusing to let them out of their sight. They don't trust they'll get the metal back. It's proof that the real physical collateral in the system is just drying up.
So we have the split reality. The paper market, the digital contracts is crashing. The physical market is screaming scarcity. What happens when these two collide? We're in this critical window now, the next 72 hours.
This is the convergence. We're sitting at a technical make-or-break level for silver, right there between $85 and $90.
It feels like a battleground. What are the key catalysts we need to be watching this week?
The big one is Friday, February 7th, the jobs report.
Connect the dots for us. Why does a U.S. hiring number move the price of a metal bar in London?
It all comes back to the dollar. If the U.S. releases a robust jobs number, lots of hiring, the market assumes the economy is hot. Hot economy means the Fed keeps interest rates high. High rates make the dollar stronger.
And a strong dollar is bad for metals.
Generally, yes. Strong jobs equals strong dollar equals weak silver, at least in the short term. But if we get a weak number, if unemployment is ticking up, it revives that hope that the Fed's going to panic, pivot, and start cutting rates again. And that would light a fire under metals.
Okay, besides the jobs report, what else should people watch to know if this crash is, fake?
Watch the premiums. That's your homework. If you try to buy a Silver Eagle and the premium, the extra cost over that spot price, if it stays high, say $6, $8, $10 over spot, that proves the crash is synthetic. It's only happening in the paper casino.
And of course, keep an eye on the COMEX inventories.
Yes. If physical metal keeps draining out of the vaults even while the price is down, that confirms the squeeze is real and not just a rumor.
So what's the game theory here? Why would anyone smash the price when supplies are this tight? Is it just panic or is it strategic?
There's a very strong case to be made that this volatility is engineered. Think about it. If you're a huge player, a central bank or a massive fund, and you want to buy a lot of physical silver, do you want the price to be $120?
No, you want it as cheap as you can get it.
Of course. So you use the paper market, where you can sell basically unlimited digital contracts, to hammer the price down. This scares out all the emotional, leveraged traders. They panic and sell. And who's on the other side? Buying.
The patient money.
The patient money. The volatility is a mechanism to transfer wealth from the impatient to the patient.
Which is a perfect transition to our last topic, the new rules of wealth. Because if bonds are this risky and the dollar is shaky, the old retirement playbook seems totally useless.
The 60-40 portfolio, it's dead. 60% stocks, 40% bonds. For 40 years, that was the gospel. Bonds were your shield.
And now they're the sword. They're the source of the risk.
Exactly. If you're holding long-term U.S. Treasuries right now, you're holding a depreciating asset that is being actively weaponized against your own economy.
We're even seeing the billionaire class reacting. The sources mention Zuckerberg and Bezos selling huge amounts of tech stock.
Massive sales. And where's that money going? It's not going into cash. It's going into land, real assets, commodities. There's a fundamental shift happening from growth assets, like tech, to hard assets.
Why tech specifically?
Because tech stocks are valued based on cash flows 10, 20 years in the future. When interest rates rise, the present value of that future money just mathematically drops. But a bar of gold is worth what it's worth right now.
There's a phrase that keeps popping up in the research. If you can't touch it, you don't own it. That sounds a little paranoid, doesn't it?
It sounds paranoid until you actually read the fine print in your favorite ETS prospectus.
Yeah.
We have to talk about force majeure.
The legal term.
Yeah.
What does it mean for an average investor?
It's a clause buried deep in the fine print. It basically says that in the event of a crisis or a market disruption, and those terms are very loosely defined, the fund manager does not actually have to give you the metal. They can just settle your contract in cash.
So let me get this right. I buy a silver ETF to protect myself from the dollar collapsing. But if the system actually breaks, they just give me back the collapsing dollars.
That's the risk.
Yeah.
You get paid out in the very currency you were trying to hedge against. And that is why you're seeing this mad dash for physical possession. It eliminates that counterparty risk entirely.
And that ties right back to China. They're building what some are calling a Great Wall of Gold.
They're trading paper promises for hard assets. They're getting ready for a post-dollar world. I mean, we're even seeing Saudi Arabia start to accept other currencies for oil. The petrodollar system is being dismantled brick by brick.
It reminds me of Gresham's Law, something I learned in school and haven't thought about in years.
It's the old principle, bad money drives out good. Right now, the U.S. dollar is the bad money. It's being printed endlessly. It's being devalued. Gold and silver are the good money.
So people spend the bad money as fast as possible.
And they hoard the good money. That is why the vaults are empty. The good money is going into hiding. It's being pulled out of circulation because no one wants to let it go.
It's a fascinating, if a little terrifying picture. You look at the screen and see silver at $85 and think, oh, the bubble burst. But the reality is the product just went underground.
The price on the screen is a mirage. It's the price for a digital IOU. The price for physical reality is, well, right now the price is sold out. We are watching the great separation of paper price from physical reality.
So let's wrap this up with a final thought for everyone listening. We've covered the debt dump, the silver squeeze, the death of the 60/40. What's the one big idea they should be mulling over this week?
The experts we read suggest you shouldn't look at this just as a market crash. You should look at it as a slow-motion bank run on the U.S. dollar itself. The entire world, from central banks in Beijing to shoppers at Costco, is trying to cash out of the dollar and get into something real before the music stops.
A global game of musical chairs.
Precisely. And in a game of musical chairs, the only thing that matters is where you are when the music finally stops. So you have to ask yourself, do you want to be holding the digital IOU or do you want to be holding the physical asset?
That is the question. Keep an eye on that 10-year yield, watch the premiums on physical coins, and don't let the headline price fool you. Thanks for taking this deep dive with us.
My pleasure.